Now you can see now we have candlesticks pattern. You can use the last one that we discussed is called the chart patterns. So if you know all this information, you can develop your own strategy here. Because this information, they are not in details, but at least you know about this. You know about good indicators, you know some candlesticks patterns, you know candlesticks patterns, you know about chart patterns. All this, the price action, you can use to develop at least a strategy on this. But yeah, but you can be having a very good strategy, but without good risk management, you are going to lose all your money. Because you can have a strategy and then you are risking a lot, or you are putting all your money inside the forex and then you put all the money, you lose at once. You are risking, you are putting 20 lot size with a very small account and you end up losing all the money. You can have all this good risk management and strategy, but when you miss on psychology, you can just be seeing the market is negative a little bit, you close, you open again, you end up doing a lot of mistakes because of the psychology. So these things work together, three of them. You can't remove and say I'm going to work with these two, I remove the other. So every time you are doing the forex, you actually have to consider this. You want to open, you want to put an entry. Have you strategized before you enter? Have you applying the strategy before you enter a trend? Have you applying risk management before you enter that trend? Or after risk management, how is your psychology? But because psychology extends even before above, even on the chart, because sometimes you can be having a bad day at work, from work, and then you end up to the chart, you end up making a lot of mistakes because maybe you are sad, or you are crying, you are too excited. Those things can make you make a lot of mistakes when it comes to this, and that's why this is very important. We have already this. So you can see now you have now the strategy here. And now let's just talk about now the risk management, because the moment you apply this two, at least this one, someone can work on his own. Mtu hii anaweza jifanyia kazi hata akiwa peke yake on the psychology, because you can go and read books, you know yourself, your person, kila mtu anajua weakness, you can work on that to ensure that you stay profitable in the market and all that. So that's very important. Now let's talk about the risk management. It's called RR, the risk management, RM. Now risk management, it means the amount of money that you have. How much do you want to risk to the market? Because you can be having $1,000, but on this $1,000 you're not going to be risking all of it. You're not going to be risking all of it. For example, you put $1,000 and you say, I want to buy. If the market goes against me, I want to lose all of it. If my market is going to rise, then I'm going to probably make $500. On that, if you lose at least once, because your strategy is not going to be 100% for you to put all this money. What if the market just goes against you on that? You lose all the money. You deposit another money. Before you become a profitable trader, you have lost $10,000. And for you to it's going to be very hard now to recover that amount of money. And that's why you see so many traders, especially here in Kenya, they lose a lot of money. And yeah, but I saw the most things that affect people in America is actually casino, because ni kama casinos ziko kila mahali and people go there and lose money. So you see now FX without risk management is equal to gambling. Without knowing how to manage your risk, the amount of money you're going to be risking there is going to be like the normal gambling. So what to differentiate between forex and gamblers is risk management, because if you are coming, you can still gamble on the forex, because forex can either move up or down, you see. And there's someone who will be coming with the money and buy everything, because the market can either move sideways, and when it moves sideways, you are not going to lose anything. There's someone who is going to be coming on the market and still buy a lot, and the market goes against him, and then he loses, because sometimes is, but you increase your profitability or what you lose by strategy and risk management. So that is what differentiates us between the gambling. Although there are so many people who are gambling from the market, because sometimes you miss psychology, and when you lose and lose and lose, you feel like, now because I've lost $2,000, what I'm going to do, I'm going to deposit $5,000 and I'm going to buy so that I can recover what I've already lost. And that is the biggest mistake now. The moment you do that, you even lose more. So those are the things that can differentiate between the traders and the gamblers. Now on the risk management side, let's say you have something. We have things that we talk when we talk about the risk management. We have different things that are very important. When kuna vitu tutamention hapa, when it comes to risk management, we have risk reward. What is your risk reward? We have leverage. It is on the risk management. It is called. We have also the lot size, and and also the pair you trend. So these things are the ones that you can consider a lot when you have money. What is your risk reward ratio? What is the leverage you're using? Loss size and pair you trend. First of all, when we started, we mentioned about the leverage, and we said if you want to risk a lot from the market, then use high leverage. Using high leverage means that you want to use high lot size, because the moment you use higher leverage, like 1 to 1,000, you see that I'm going to be risking a lot from this market, and I'm saying that I can use higher loss, which means that you are exposing your money a lot to the market. So you see these very important things that we have here. The lot size. Remember, we also mentioned where you do about the lot size here. We have like that lot size. You remember where we are adjusting the lot size, where we were saying that if you have 200 points and you multiply times the lot size, then this one is that the lot size here is the one that determines how much you can make. If you put 200 here, 200, these are 3 different people and they use different lot size. This one uses 1 lot size and the other one uses 0.1 and the other uses 0.01. This will be different because this guy here will be making 200 times 1, which is $200. If this one will be making $20 and this will be making $2. Yeah, because of the lot size. So you can see how lot size is very important when it comes to the money, the one that you are now risking on the market. Now the most important thing here is called the risk reward ratio, that is mostly on the hiyo. Sasa ndio imefanya tuongee about risk management, because when we talk about the risk reward ratio, we are talking about what are you risking for reward. Reward is like profit. So this is what is your stop loss, what is the loss, the profit. So I want to show you something here. Assume now you are risking $20 to get $60. Is that worth it? What about if you are risking $20 to get $20? So this is good, but this is not good. What about if you are risking if you are risking $20 to get $10? So it means that you are putting your money so that you can get $10, which means if the market goes to your side, you'll get $10. But if you lose, you're going to lose all money, $20. That is what it means here. So this is still wrong. So why is this correct? Why is this correct? And why is you risking $20 to get $60? This is how it is. So if you're risking $20 to 60, so it can be written 20 to 60, 20 to 60, which is a ratio of, you divide it, remove 0, then by 2, 1, by 2, 3, which is a risk reward of ratio is 1 to 3. So most of the time you'll see it is written P3, which means on the profit side your risk reward ratio is equal to 3, which means you are risking $20 to get this amount of money, which P and L is equal to 3, which means your risk reward ratio is equal to 1 to 3. Sometimes it can be written P and L ikuwa imeandikwa 2.5. Yeah, 2.5, you multiply this times 2, it will be 10, it will be 5 on this side, but on this side it will be 2. So it is a risk ratio 1 of 2 is equal to 5, which means kama unaweza weka any amount of money. On this case you can be risking $200 to get $500, which, yeah, this 2.5 times 2. So we are just going to make it a whole number, this one. So it's like 1 is equal to 2.5. So multiply times 2 makes 2 is equal to 5. So it's like risking yeah, so it's like risking $200 to get $500. So that's that amazing. Now let's do some little calculations here so that I can show you something, and you follow on this, you see how the market. Assume you take 10 trains, and these are 10 trains that you take. Look at least the calculation. See, there's something that we call strategy. You develop, so the strategy is very important here because you have to apply it. The strategy you can take, if you want to know how much your strategy is, how your strategy performs, you can take 10 trains. Chukua 10 trains, uone kama zitahit your TP 10 times. Kama zitahit 6 out of 10, this is like 60. Your strategy is 60%. If kama zitahit 5 out of 10, this is 50%. Sijui kama unaelewa hapo. Now, yeah, so this is your strategy. You try, this is the number of trains as you take. For example, leo unaweza chukua trade moja, kesho uchukue ingine. At the end of 10 days, the 10 trains that umechukua, ukaenda loss 4, ukawin 6 out of 10 trains that you took. That means if you divide that and do your calculations, si itakuwa 2 times. If you multiply this times 100, si itakuwa this times 100 times 6 out of 10 times 100 is in 60%. 5 out of 10 times 100 is in 50%. So what do we do if your strategy is 6 out of 10 and you want 6 out of 10? You always make sure that at least you improve on your strategy. you make sure that you improve on strategy. Una improve vitu zako sasa juu kuna you improve on your strategy to be next time inaweza kuwa 61, inaweza kuwa 64, inaweza kuwa 70, inaweza kuwa 80, yeah, mpaka inaenda hivyo. So it means you are perfecting your strategy by combining a lot of things. Developing a strategy is very easy because kuna zile vitu unatengeneza wewe mwenyewe. Unasema first of all, before I open the chart, this is what I'll be looking at. Nitakuwa naangalia 1 2 3, alafu naenda kwa time frame fulani, naweka indicator fulani, naona kama inanionyesha vitu fulani. Kama kuna kando ina form hivi, najua it is time to buy or sell. You see? So that's how the strategy is actually developed. Now, assume you have 50% strategy. 50%, the strategy that is working 50%. Okay? In other words, people say that when the strategy is 50%, hakuna kitu to make. But I want you to show the power of risk management. Assume you took as trend 10 trends, but your strategy is 50%. Winning, in a win 50%, which means iko 50-50. See it iko 50-50. It means you lose 5, you win 5. You lose 5, you win 5. But there's someone who will lose money here, and there's someone who will be millionaire from this, and will be making a lot of money from 50% strategy. Assume you take 10 trains. If you take 10 trains, 6 of them, 5 of them wins. 5 of them wins. And remember now, let's put your risk reward ratio to be 1. Tulisema ile kwa safe kabisa. Unakumbuka ile tulisema 20 is equal to $60. Ilikuwa ratio ya 1 to 3, si ndio? Because hapa kulikuwa $20 is equal to 60. You are risking 60. You are risking $20 to get 60. Tuka cancel hizi, tukasema ni risk reward ya 1 to 3. Assume now you win 5 out of 10 trains. Now uko na risk reward ratio ya 3. Yeah? 1 is equal to 3. There's someone here will be more profitable than the other person. Why? Assume if you have, for example, $1,000 here. I just want you to look at this. So if your strategy, you have won 5 out of this, you are risking 1 to get 3, and you have won like this. This is 50 or 50%. And you took 5 trains. So what normally happens here is very simple. Kwa sababu out of these 5, I want to make this to be very simple so that you just understand. Let me go to the chart first. So let's say like this, you earned, like for example, $1,000. Let's say you earned $1,000, okay? And your strategy is 50-50. That means you lost. Your risk reward ratio is equal to 1 to 3. And you took 5 and you took 10 trains, and you took 10 trains. This will be very simple. And you took 10 trains. The lot size is still on this. We'll be coming to the lot size still. It is still in there on the risk reward. No matter how you the amount of money, because we are going to how much are you supposed to be risking in terms of percentage. Yeah, let's say you take 10 trains and your risk reward ratio is equal to 1 is equal to 3. You are risking 1 to get 3, and you took 10 trains. Now, if your trend is 10, if you took trend here, trend, and you lost 5, you have lost 5 of them. This will be 5 times 1, which will be 5. And you won 5, so which is be 5 times 2 times 3, which will be 15. So you see, your profit here will be 15 minus 5, which will be positive 10, because you lost this and you won this. So this is positive 10. Even if you calculate this money, for example, in terms of dollars, let's say you were trading to risk, you took 10 trades, but all of them you are risking $20. Okay, so it means for the first trade you ulienda uka risk $20 in order to get $60, and you didn't this one, so you lost how many dollars? Because you ulitupa tano, you lost on this side 5 times and you won on this side 5 times. That's what I mean by saying the risk, the strategy is 50%. You lost 5, so you are risking 5. You are risking $20 to get 60, and you lost 5 and you won 5. So which means out of 10 trade, you won 5 out of 10. So which is 5 out of 10, which means you lost 5. So on this scenario here, how much did you lose? You lose $20 times 5 trades that you took, and you lost $100 here. On this side, you won 5 out of 10, which will be now after eating your TP, which is 60. So you 60 times 5, which is $300. So at the end of the day, you have negative 100, but on this side you have positive 300. If you minus this or you plus this one, you see that is 300 profit, but on negative 100. At the end of it, you have positive $200. And your strategy is 50. Yeah, and your strategy is 50%, which is 50. So you can see, even when you have a strategy that is 50% is okay. The same thing with 40%. Assume now on this line, assume this on this line. So this is the power of the strategy. This is the power of risk management. If you have the same amount of money here and you are risking 20, but this time you won 4 out of 10, but your risk reward ratio is equal to 1 to 3. This is like your strategy is 4%, 40%, because 4 out of 10 means times 100 is 40%. That is actually even below 100. But if your strategy is that weak, 40% strategy that is winning, you are supposed to still to be making money. Why? Because if you won 4 out of 10, that means here will be 4, and here you lost 6. You lost 6 and you got only 4. If you multiply this, if these are $20 here, it means you will have lost 6 times 20, which is $120 that you lost here. So this is negative. But on the other side, if because you won 4 out of nini, it means and your risk reward is equal to 1.3, that will be 60 times 4, which will be positive 240. So at the end of the day, you can see you only lost 120, but already you are positive 240, which will be 240 minus 120. It will be positive $120. So you can be having a weak strategy that is 40%, that week was so bad because out of 10 days ukiwa unachukua one trend ukawin only 4 trains out of 10, you have to be profitable still. No, not the strategy here, but also the risk management, kwa sababu risk management also applies here because it is 1 to 3. If this was 1 to 1, you could be in losses. If there's risk reward you see here, yeah, will be in 1 to 1. For example, here 1 to 1, that means you are risking. For example, here if your risk reward ratio will be 1 to 1, that means you are risking $20 to get $20. Okay, so it will be very bad. If you lost 6, for example, the way it is here, if you lost 6 and won 4, it will be in chaos because here you have lost negative $120, and here it will be 20 times 4, which is 80. You only won $80. So you can see you have more losses than profit. So here it will be negative 40. And that's the power now of risk reward ratio. If your risk reward ratio is higher, for example, 1 is equal to 2, 1 is equal to 2, 1 is equal to 2, for example, 1 is equal to 2, that means, for example, you are risking 20 here to get 40 here. That means hata kama ilikuwa 1 to 2, which is the smallest, could risk 1 to get 2, you are $20 to get 40, that is still okay, because kama umekuwa umelose mingi hapa ukalose 6 out of 10, na hapa hiyo wiki maybe ilikuwa wiki baya, and your strategy is 40%, which means now improve on your strategy because you are risking a lot to get small and not that big. So you can see on here, it will be this side, it will be 40 times 4, it will be $160, 160, but here it will be 20 times 6, which is 120, negative 120, because this is the loss side and this is the profit side. So here will be 120. So you can see still you lost 120 and you got 160. Here it will be positive because it will be positive $40. And your risk reward ratio was only 1 is equal to 2. And you lost more than you won. Because of risk reward ratio is equal to 1 to 2. You lost 6 out of 10. You won 4 out of 10. But because your risk reward ratio is good, then that is the time now you make more money. Let me show you that in the chart so that probably I'm going to get how we. So on the chart, we will see something like this when we are coming to the market. The one thing that you'll be seeing in the market look like this. Kuna hiyo kitu tulichora inakaa hivi, inakaa triangle form like that. So na ikagawanya this way like that. So most of the time, this can, if you are using good risk management like all that you see, this side will be like red. Let me show you something so that you can be having in mind. This side can be in red and the other side just to be in green. Why? I'll show you something here. So this side, assume now is green and the other side is red. This means now you are going to be seeing this thing on the market. This is now can be entry, and this is your stop loss sign. This is SL, stop loss, and this can be now the green sign is TP. si unajua tu green ni profit, ikikuonyesha green on this side ni profit. So this is a TP on the red side. So you can see now, this is not a candle. This is the one thing that I'm going to be showing you in the market. When you see this thing here and you draw it into the market, and assume now the candle are moving like this, and they took the trend and moved all the way and eaten just like that. If you end bought this market like that, then it means you bought, because when the green is up, it means that you bought, and this is the stop loss. In case this market could have come to this position, it could have been a stop loss. It could hit your stop loss around this area, but this was your entry. The market touched the entry, and the market moved very up like that, and then it touched your TP. If you look at so well, the distance between here and here in SL distance na hii ni TP distance, you can see it's like this is like 3 times of it, sinona. So this can provide a risk reward of, hii inaweza kuwa either 1 equal 1 2 3, hii inaweza kuwa around 3, that movement. So it means you are risking only these pips here to get all this profit when the market comes to this position. Yeah. So let me show you on the chart so that you can see how it look like. Students are losing a lot of money. You know, they just come to the market, they just want to make money, and I don't know. Now you can see, for instance, the one that I drew here of the Euro USD. Let me extend the screen. You can see this one, You just take it. It is here. This one. It is here. You can see it is written long position and short. This is for long, because you can see stop loss is downside. The short one look like this. If you put it like, for example, here, like here, it will look like that. You can see you just take it from the trading view. You can, your entry where you just want to enter, for example, in this, if I just want to sell around this area here, if I just want to sell here, I can just take this short, and then I put it here like that. I can adjust my TP to where I want, for example, like that, and then I reduce my stop loss up to this position. Now there are a lot of things that you learn from this. Like example, this one, you see the moment you press it, it will show you everything. For instance, the target, it will tells you the target here is how many amount of you are targeting here. It is 373 points. Amount you bought at this position here, this one, and also it tells you can see the risk reward ratio. Sijui kama unaona you assigned, it is 2.76. so that is good, something that is above 2 or more. Equal or greater than true, so that is okay. And that's why it can see it's selling you like that. If you adjust this to go up, the TP to go up like this, you can see that the risk reward ratio is increasing, because I'm saying I want my market to come all this with risk reward ratio to come to 5. You can even, sometimes you can be having a good day and the market can jump even to your bought at this zone and the market goes all the way to 5, which means if you wanted to risk $20, the market can buy and move all the way up. You went and you risked $100 to be your SL, and out of that you got 5, which is be $1,000. That will be very amazing, yeah, on this area. So you can still adjust this, and your TP, when it will be hit around this position here, it will be very simple like that. You can just adjust everything here, and unless the market goes against you and you know what you are doing, because you can see you have to work on your strategy first. That is why we started with the strategy. If your strategy, and you test your strategy first of all with the demo account, you see you can take like 10 trains. That is number one. You take 10 trains, you mark them. How much did he hit? Ningapi zilihit at least over 1.2. Ukitumia risk reward ratio kama ya hii, how many of them hit the TP? How many hit the SL? No, you can work different market. You can work on the different markets. Yeah, you just work on the different market to determine where you want things to be. Yeah, you just work on different pairs that you want. You can practice on different pairs to understand them more, and then you test your strategy depending on now the risk management and the strategy that you are using. You calculate after every 10 trains, unaona kama ni hii time zile zinapaswa kuenda above 1.2. So that's how you test your strategy. Kama itakuwa over 50, then you know it's okay. Yeah, sana nasemanga 1.2, because yeah, we risk 20 to get, you risk 1 to get 2. Unaona? Yeah, that is when you have, and the strategy will actually be nice. That will be nice. So una count, unaona, out of 10 zile trade nimechukua, how many of them did hit the TP of the above 1.2? Hizo zote, how many of them? Unaona ni 6 out of 10. Hiyo ni bandu monyo umefanya, like this is season 1, umefanya season 1 and you have seen out of 10, hiyo ni 60%. You try again and you see imehit 5. So imehit 5, you try again 3 times, out of 10 umeona imehit 50. So you plus 50 plus 60 plus 55, then you divide by 3, and that will be your strategy winning rate. And when it comes to that, now you see you start now learning a lot of things that will tell you, now this is my strategy, it is 55%. What can I do to improve on this? Where am I making mistakes because I'm not perfect? You now start improving with the time. Every month you make sure that you have entered something new or something you test on your strategy. If it works, it becomes one of the part of your strategy. You improve it. But at the end of 3 months, 5 months, 1 year, your strategy is good. You have a good strategy and you know how to play with the market. Yeah, you see, it's a lot of work here. So I think we will assume from how to analyze the market using all what we have learned, and also some of the risk management, so that we can start to answer to pole on how to apply on that. At the moment you utakuwa umeelewa on the technical analysis, how to analyze and risk management and strategy, ya mwisho sasa after umeelewa hizo about technical analysis, how to analyze market, ya mwisho sasa tutaongelea about the fundamental analysis and sentiment ikiwa za mwisho huko. Yeah, so what we will do, so that usisahau vile tumesoma from the beginning, we are going to start like trending. So you make sure that you have the demo account. We are going to, so that you can now start knowing from pale tulianza, because if we continue learning without the proper practice now, yeah, but you can see now atungeendelea without this. That is why I wanted at least to reach there, although there are a lot of things to learn here, but we'll be learning them as now we can resume few days to try and train on the demo account to see how it's going to be. As we now, it's like revision of what we have done, and then the moment you gain the momentum of that, then we can go to the next topic. So that is how, yeah, that's how is it. We will try to see what we can do. Okay.